Good afternoon, everyone. Thanks for joining our last webinar of the year. I'm Justin White. Today I'm joined by Jason Brooks, who is usually my co-host on these things. We thought we were going to be done at the first week of December, but decided to have one last time to get together to talk about what we really see as a phenomenal opportunity and one that's been getting better since its inception, that being opportunity zones. Interestingly enough, Jason and I, do this webinar fairly frequently, and we talk about a lot of issues where people are investing money. Different ways that people are making money on real estate. We deal with a lot of legislation, but initially, Jason and I met talking about opportunity zones in maybe late 2017 or early 2018, as this just had started to kind of get some steam going. Jason's got a long track record of working with numerous opportunity zone clients, creating opportunity zone funds. And what our goal for you today is to maybe put one last present under the tree, and that's to help some of you realize maybe some better ways to utilize some of the capital gain that you've had in 2021 into putting it into some investments that'll shelter some tax dollars and make you a good bit of money. So what our plan is today is Jason and I are going to go through kind of the mechanics and what is the opportunity zone opportunity. We'll also talk about what most people have been doing in opportunity zones, or what's the way that a lot of passive investors who didn't want to go out and build a property have been doing in opportunity zones. And then we're going to talk a little bit about what we think is the secret opportunity that's available now that we've learned a few things over doing some of these deals in the last few years that we really think is a great passive opportunity for people to be able to shelter a lot of money. So with that, Jason, I'm going to let you start in the early going. Why don't we get started a little bit of the history of opportunity zones. When did it pass? What was the intent, and kind of what is it?
Well, an opportunity zone was created in order to spur economic development in certain census tracts where there was lower income. And now these census tracts, which we'll talk about later today, are not always in, rougher neighborhoods. Actually, some of them are well positioned in very nice neighborhoods, and we can talk about deals and, where those are and what they look like. But no, the opportunity zones were created to take capital gain that people have made in the market since, let's say, the last crash around 2010, and take those profits, encourage people to realize those gains, and then reinvest them into these opportunity zones to spur economic development. They were passed originally in 2016, and it was part of a tax bill, and they will last for 10 years, and they will expire officially at the end of 2026.
All right. And so talk maybe a little bit more on the intent, what the intention of it was. It was bipartisan in the support for opportunity zones as a vehicle to help some of this investment and improve neighborhoods. If you want to talk a little bit more about that.
Sure. So it was a bipartisan bill because the conservative side of the House and Senate thought it was a way for protecting and sheltering capital gains, and the liberal side of the House and Senate thought it was an opportunity to reinvest funds into areas that needed it the most to spur growth and development. So it was something that I believe was actually chaired by Cory Booker on the Democratic side, and I forget who the chair was on the Republican side, but it passed with pretty resounding support across the board. And it's actually turned out to be a pretty good opportunity for people that are willing to take advantage of it. There were, I believe, 800 opportunity zones in total designated, with, I believe, over 10% of them being in California and over 50 in Southern California alone. And as you can see on the map, just in LA County, there's plenty of great opportunities. I think there's a couple down there in OC too, but we can talk about some of the neighborhoods that you'll see in there, Culver City, San Pedro on the water, up and coming area. I mean, I think there's some spots in Redondo Beach, there's places in Huntington Beach. So opportunities where you would say, well, that's a place I'd really like to own a piece of property. Opportunity zones originally had a negative connotation because they were lower income census tracts, but there was, some finagling, you could say, to meet certain Congress members' districts and encourage investment and support there. There was a little horse trading that went on to get certain districts in.
And just for a second, why don't you talk about, I remember, when we first met, the approach in the opportunity zone, or where where people could benefit was kind of pretty narrow. Talk about maybe, how has it worked so far? What are the most common investments? How are people investing in them?
So originally, and I guess we can talk about how the investment worked, and as a basis to start was you're encouraged. There was two ways to do it: through real estate or through an opportunity zone business. Today we'll focus mostly on the real estate portion, but imagine you find a property that you identify. It's $1 million. The land's assessed at 500,000. The building's assessed at 500,000. You can acquire the property with debt and equity, but the equity all needed to be capital gains. So you realize a capital gain event, let's just say Justin sells some Apple stock he bought at the IPO, has a big gain, decides he wants to invest it. So he has 6 months to decide to invest it into an opportunity fund. And then from there, the opportunity fund has 6 months to identify and acquire a property. And then from there, they have a few years to improve the property. And you're required to improve the property at a minimum with capital gains funds equal to the amount of the assessed value of the current improvements at the time of acquisition. So far, what we've really, this was in the very beginning, right? And so there was not a lot of IRS guidance on it. And since then, the IRS has given additional guidance. And a couple of things to keep in mind: if you got your capital into your opportunity fund prior to the end of 2019, you got a discount on the actual capital gains tax bill. So your capital gains tax bill is actually now due April 15th of 2027 if you're in an opportunity fund. Now, it's important to note that in California, we do not recognize capital gain. So if you have a capital event in California, you need to pay the taxes the following year. But your federal bill gets not only a deduction, but you get to pay it, anywhere between 9 and 4 years or 3 years after you realize the event, which is actually interesting considering now, Justin, that we're going into a time of higher inflation. With that higher inflation, if you had a 5% inflation a year and you got to delay paying your bill by 7 years, let's just say, for example, you're looking at 35+% potential savings, and based on inflation and what you have to pay. Also, if you enter into an opportunity zone fund prior to the end of this year, 2021, you get a 10% reduction in that bill. So those are some of the real basics. And what we have seen is most people end up in the beginning ended up finding ground up opportunities that they could build. We were really encouraging people to buy fully entitled, fully permitted opportunities, because originally you had like 30 months to build and improve the property. Now you have more time. The IRS has expanded on that. We had 30 months, so you needed permit ready building opportunities or big value add rehabs. Now, as Justin and I will talk about today, there's a lot of other opportunities you can put your money into.
Well, I think the other thing to maybe add there is that, when in the early going, it was targeting active developers who were comfortable building a project and can move something through a city. Or if you wanted to get the benefits, you had to kind of ride sidecar as a passive investor in an opportunity fund where somebody else had total control of how your money was going to perform.
Correct. And it was a less liquid investment because you were ready to sell the building, and remember, it's important to note the benefit of this is when you sell the building, as long as you hold it for at least 10 years, you pay no capital gains on any profit made on the building. So you can additionally depreciate the building down to zero. And when you sell it, you pay no tax on any profit that's made. The other thing to keep in mind is you're supposed to exit the property by 2047. And so, Justin, to your point, it was really a developer that knew what they were doing and that they could build, or you were just set investing into a fund and hoping the person knew what they were doing.
And so a couple things. One, if you have questions throughout the presentation today, please use the chat, and we'll get to them as they come in. But Jason, talk a little bit about, as you talked about, you got to own it for 10 years and certain things run out, but you've got until 2047.
Correct.
So talk a little bit about those years and all those dates.
Right. So let's just assume if you're not in an opportunity zone fund now, you probably won't get in before the end of the year. So let's say you put your money into your fund next year. This is how it would go. You would acquire the property next year. you would pay your assuming you're a California resident and realize your gains in California, you pay your California gains on your 2023 tax returns, and your federal returns would show a capital gain at the end of 2026 paid in April of 2027. So you do get a benefit and delay in that execution from a payment standpoint, Justin. And it's interesting because over time, what we have seen is, we've learned more about how you can finance them and how you can build them and how much time you have. And it's starting to become an opportunity that makes sense for other investors. And one thing that we kind of encourage people as well is, this is also a hedge to something that Justin, you and I talked a lot about this year, was the potential elimination of the 1031 exchange. So you could realize a capital gain on the sale of a building where you just take your basis back tax free and all the profit you realize as a capital gain. And then instead, you could use this to hedge where you're going to have to pay the California taxes now, but in the future, by the way, now your estate can inherit your position and pay no tax on the exit. So it's something people are looking at as a hedge to 1031 and a way to change their portfolio around, because if you've exchanged 5 times and have a basis of $10,000 on a $3 million building, at some point, it's a tax deferred exchange, not a tax avoidance plan. So.
All right. Talk a little bit about the funds, or how the mechanics of, I've got a capital gain, sold my business, or retired because my business I was keeping around, but I finally sold it. I just got $20 million for the sale of my business. How do I do it? What do I have to do? Do I just go find a property and buy it in my name, or how? Talk about the mechanics of acquiring property in an opportunity zone.
So the important thing is everything needs to be run through a qualified opportunity fund. When I say that is, you can have 2 kinds. There can be a self-directed qualified opportunity fund, which is a fund that you alone are the investor in, you alone control. Justin and I have a client that we're working with now that had this business exit, kind of like we discussed. We set him up legally with an entity that is a qualified opportunity fund. He funds his money into that fund within 6 months of the capital event. And important to note, by the way, many of you, when you have a business sale, have delayed payments, right? Payouts over time. So each time that you have a delayed payment, you can actually continue to invest in the fund and buy an additional property or put it into your current deals. But you put the money into the opportunity fund, then that money needs to be used for the deposit. That entity needs to go into contract to buy the deal. And then that entity, your fund, will close, own, and acquire the property. It won't be in your name. It needs to be in a qualified opportunity fund. If you're just investing with a third party, all you have to do is invest your capital gains directly with them, and they'll take care of the paperwork portion. Now, it's important to note, you also need to file forms either annually or semi-annually, depending on the fund, with the IRS, just to let them know how the funds are being spent and that you're tracking appropriately. And we can coordinate that with your accountant.
Okay, I've got a couple of questions that I think people will want to know. How much does it cost to set up a fund?
If it's a self-directed fund with no other investors, it runs you anywhere between $7,500 and $10,000 roughly, is what we've been able to do it for.
And people are saving hundreds of thousands of dollars in capital gains.
Yes. I could argue that we should just charge a percentage of whatever the savings is, but that's not fair.
Well, I thought it was fair for everybody to hear the cost, but also reminded of the benefits of doing it.
The benefits really it can be extraordinary. And we'll talk, Justin, too, about depreciation and offsets and really how that you can see some real benefits out of this as well.
Yeah, we'll get into some numbers. We've got a couple of examples later in the presentation of, what it looks like when you put the money into an opportunity zone versus if you buy a non-opportunity zone asset. Examples that we'll show you in a second.
And Justin, something to keep in mind too is it's any capital gain, right? You can sell stock. You can sell stock. Let's say, like I said, Justin invested in Apple at the IPO and has a huge gain. You can sell stock and now use the capital gain from the stock in order to actually buy real estate, right? Or, you could sell NFTs or Bitcoin or cryptocurrency where you have a really low basis, are going to make a large sum of money. You can sell those right away, put them into an opportunity fund, and buy, real estate. And you can also do it from the sale of real estate. You can do it from the sale of art. So.
Who has the money between when I get my capital event and when it goes into the fund? Does it have to be held by an accommodator like an exchange?
No, you're in control. It stays in your bank account. So you're in full control of your funds. The funds go into your bank account. Once we get your opportunity fund set up, we get your bank account set up with your EIN, you fund the money into there. And the important thing to note, Justin, is if you sold your business for 20 million, you could just choose to put 8 million into in the opportunity fund. You could put 6 million, and you don't have to put the full amount, which is something very different than like a 1031 exchange where you're required to roll the whole amount. Here, you can just roll a portion if you want to. And if you had sell stock, let's say you bought stock for 100 a share, you sell it for 200 a share, you're actually only rolling in that 100. You're not rolling in the other 100. So it actually puts capital potentially back into your pocket tax free.
So I've got 180 days where I can use my money to maybe make a short-term investment before I put it into the fund.
Correct.
And then how long, once the money's in the fund, do I have to invest in an opportunity zone business or an opportunity zone property?
Generally, it's about 6 months. You have to identify and acquire. So really, it's a year from the capital event is what we tell people. There is a theory that if one of the ways they got around longer term build and development projects was creating the project as an actual business that was building it. So you could take capital calls over the course of a 5 or 6 year period if you were building a high rise, for example. And so your money doesn't have to be all put to work right away, but the initial acquisition of the property or the initial investment in the business should occur within 6 months of the money entering the fund.
So the opportunity zone gives you a lot of flexibility within, let's call it the opportunity zones, that you've got more time to look at and determine what assets are best. And you've got control of your money for at least a good portion of that time before you have to put it into the fund.
Correct. That is
Any
correct.
other comments on, let's call it, fund setup? You talked about being able to put more money into the fund. Maybe for a second, talk about, can funds use financing? Can funds refinance? What if I wanted, I had this $20 million gain and I'd really like to get some of it out. Do I have to wait 10 years before I can touch any of it? How's all that work?
Well, as I said, you can buy deals with debt, right? So as long as, and we'll talk about some more of the economics and the math behind it, but you are allowed to use debt. So you can use leverage for those of you that are really concerned about your levered returns. But to Justin's point, you cannot cash out refinance directly from the deal and distribute it to yourself for 2 years after the acquisition of the property. Now, we might talk about a deal example a little later where you could still potentially refinance if you got an opportunity to buy a deal all cash. But that's something that, I think we'll touch on shortly. But you can use financing, you can get leverage. And after 2 years, you can refinance and cash out as many times as you want. So a lot of people are planning, Justin, to do cash out refinances around the end of 2026 or the beginning of 2027 when their federal tax bills due, so that they can pull some extra money off the table to pay that tax bill should they owe at that point in time. And I think we'll talk about depreciation and some other things that might help, but should they owe money at that time, it's a great time to consider a refinance.
Excellent. And maybe, and I know we're going to talk about it in some examples, but you could acquire a property all cash, and then can you refinance and leave the money in the fund for the fund to go acquire additional assets?
Yes. You cannot distribute the cash is the IRS ruling. So you could refinance and then go buy an additional property with it, or refinance and use the refinance proceeds to improve the property in another way as well. Which might be interesting, Justin, if you bought a property all cash and part of your value add was refi out some capital and then build like an ADU or two in the back. That could actually be an interesting time. You might use that on the same property. And obviously we can talk about buying different properties as well.
Going back to if you were going to, let's say, refinance and acquire additional property within the fund, it would have to be in an opportunity zone. You just want to clarify that?
Correct. Correct. And I believe it's 90% of all the assets owned by the Opportunity Fund need to be in an opportunity zone. So if you bought 10 properties and they were all roughly the same price, you might be able to buy one that wasn't. But at that point, I just think like we've really started to find some really great opportunity zone properties. So that's something where I think you just stick it all in the opportunity zone and don't get close with the numbers.
Yeah, I'd agree. I think there's a kind of an intersection of where some great properties and some really good locations within these opportunity zones kind of intersect, and there's some really good opportunities. I've got this slide up. Why don't we talk a little bit about the things on the bottom? Because you can't invest in any sort of business or any sort of property in an opportunity zone. And talk about what it's got to do, whether it's job creation, as well as some of the things you got to stay away from.
Right. So the goal of this was to create jobs and revitalize communities. So the first thing is no pure triple net leases are allowed. You can't do triple net leases because those are passive, right? They're completely passive. They don't create jobs. The goal is to have some management involved, people working, whether people working at an apartment building, that's the goal. So pure triple nets are not allowed. That's the main one from a lease structure standpoint. And then as the type of businesses that you have as tenants, and Justin's got a great slide up here that shows this, anything that's classified by the IRS as a sin business, and there's a great list here. No country clubs, no massage parlors. I don't believe you can have a liquor store. The interesting part of it is, though, technically because cannabis is federally illegal, it's not listed as a sin business by the IRS. It would be kind of interesting to go down that path and see what would actually happen if it went there. But as of right now, that's kind of a gray area that, we'll see when cannabis becomes federally legal, which I forecast will be in the next 2 years, probably, how that gets addressed at that time.
All right, let's move on a little bit. You had talked a minute ago about triple net leases and that they weren't job producers, and job production is a big part of an opportunity zone and what the program is trying to encourage and facilitate. Talk a little bit about leases and that aspect of it, and the active management component that is required in creating jobs.
So there needs to be an active and ongoing business that leases the property from a job creation perspective. I think someone tried to buy a property and have a affiliated entity just lease it out from themselves, and they kept it vacant as dirt. It was a land banking style of play. That's not allowed. So owning the property is not enough. There needs to be an actual lease with a third party that is at arm's length. The party needs to discuss or needs to operate a business. So a tenant that's doing manufacturing or selling food, those are great, opportunities where you're creating jobs. And again, pure triple net leases are not allowed. And remember, it says triple net leases. It doesn't say some other things, which I think we'll talk about, but you can, have a double net. You could have, modified gross. You can have some other where there's still less work involved as an active owner, operator, or landlord, but still you get a lot of the benefits.
And I think that active management component, when we talk about triple net leases, is that, well, who has to manage the property? There's no job there for somebody to do. You can either do it yourself, which would be active management, or you would pay somebody to make sure and do the landscaping and sweep the parking lot and do that sort of stuff as it relates to when you own the real estate. The business component's pretty easy, right? If you invest in a business in an opportunity zone, there's job creation there. But also from a real estate standpoint, both the construction of property creates jobs, but also the maintenance and operation of the real estate is another job creator. And that's why, as long as it's not a triple net lease, it's going to satisfy the requirements of the IRS. Okay, so let's go to this next slide.
One thing, Justin, Edon asked a really good, an interesting question on what's the difference between an opportunity zone and a preference zone. So preference zone dates back to something in the early 2000s, which were economic encouragement zones where there was tax benefits for opening and operating a business in those zones. The last preference zone expired at the end of 2007 or 2008, I believe. Now, that was federal pref zones. There are cities that do offer tax incentives. So hopefully that answers your question,
Edon. You had said it a second ago. It'll kind of lead into some of our discussion. You'd mentioned land banking. And can you do that? Can I just go buy a piece of land in an opportunity zone?
No, you can't just buy it and just leave it. I mean, you could, if it made sense, you might be able to, if it was a dirt lot already, you could buy it and put a parking lot on it and then, operate a parking lot business with parking that made cash flow. And there are plenty of opportunities that, parking makes a lot of money, as we know, in downtown LA and other places. So you could do that if the numbers added up. I actually had a client that did an opportunity zone deal where there was an improvement on the property, but prior to close, they released 50 grand and had the seller demo the property, like literally demo it to the ground and get rid of the structure. So when they bought the property, the value of the improvements was a dirt pile. And they knew it was going to be a long slug to go through. This was before, Justin, you could take 5 or 6 years to build the building. They knew it was going to be a long slog to get through entitlements, permits, construction. So they turned it at first into the parking lot, which was making parking revenue, right? And when they were operating a parking business there and making revenue, and they were employing people to run it. And then from there, they ended up, getting the plans, and they're going to start construction in about 2 months.
Okay. So let's talk a little bit more about construction and some of these things. Significant improvement is a key qualifier for the tax benefits of an opportunity zone. Talk about how much significant improvement. You just told a great story about a demo, and then because it was going to allow them to do it. Let's talk significant improvement so everybody understands what that key factor is. Because I think as we go through this, understanding leases, understanding significant improvement, understanding the tax benefits, understanding how you can finance, and understanding how you manage the properties within an opportunity zone allows you to tap into what we think is the maybe minimal management secret opportunity in opportunity zone. So talk about significant improvement.
So significant improvement means, and I go back to the example I used at the start, if you buy a property for $1 million and the assessed value of the improvements is $500,000 and the assessed value of the land's $500,000, you need to improve the property with capital gains funds equal to the value of the existing improvement. So you need to put in $500,000 improving the property. It doesn't all have to be in one shot, but it has to be over the course of a few years to make those improvements. And so in our situation, our scenario, you'd buy it for, let's just say you could get 50% loan to value. You could buy it for $500,000 in capital gains, $500,000 in loan proceeds, and then you put in another $500,000 to improve the property. The big issue in finding deals that work is making sure that you have a plan on how you're going to spend the money for the improvements, and knowing, kind of having an idea of what you're going to do. And Justin's next question, I'm going to guess, is going to be, what is the assessed value of the improvements, and how do we determine that?
Yes.
There's a couple of ways. You could have an appraiser, as long as it's a licensed appraiser, and it will need to hold up. I mean, the easiest way to do it is the assessed value from the county tax assessor's office, because most of the time it's going to be hard for, let's say, a federal IRS auditor to question what the county of LA's tax assessor said the value was, right? That's I believe to be the most bulletproof. However, you could use an appraisal, especially where the previous seller, owned the building for 30 years and the basis on both items is pretty low.
Excellent. And we got a question. You can see it there. Can the capital gains, which are being invested in the opportunity zone, be used to buy out existing tenants at the property so that the units can be made vacant and then renovated?
This is a great question, actually. I don't know.
Really is.
No one's tried to do this yet. I think you tie this towards all the improvement and operations of the property. I don't think we could get excessive. So let's say you're buying a triplex in RSO Santa Monica. That's the rent stabilization, rent control in Santa Monica. I don't think that you could pay 75 grand out of, let's say, your 500,000 in improvements to buy out one tenant. But I think if you paid 50 grand to buy out the three tenants, and then invested the rest in the improvements and upgrading and everything else, you could expense it in a way where I think you could actually make it make sense. So I think you could use a decent amount of the money. And again, Alexander, remember your your minimum is the 500 in our example. You can always use more, right? So let's just say you're going to use 500 on the renovation and you needed 50 to buy the people out. You can put in the 550, shelter the 550 and use the 50, I think. But if we're starting to get to a point where, we need to do 500 improvement and we're doing 375 in improvement and 125 in buyout, it might get a little dicey.
Awesome. Before we talk about some of the great opportunities in opportunity zones, any other points that you want to cover, Jason?
I just think that this is when these came out, Justin, you and I talked a lot about them, right? Like we were speaking on them, we were going to events about them all the time. And then it kind of slowed down towards the end of 2019 when people thought that they were losing the big benefit. And then it's kind of sped up a lot this last year. You know, I think that regardless of the reduction in the tax bill you might get if you put your money in before the end of the year, I think getting to wait 5 years to pay the tax bill with the potential inflation that we're going to have is going to be a huge savings in itself. And if you combine that with being able to hold a property for another 25 years before you sell it and pay no tax on any appreciation, as well as cash out refi as much as you want after the second year, I think there's just a real opportunity, especially I like the hedging against an elimination of 1031 on any really low basis property you might have, because if not, like we talked about, you might be stuck in a property 15 years from now because your basis is low, 1031 is gone. And unlike some basis elimination potentially of step up in basis and other items, the benefits of the opportunity fund can pass through your estate.
Well, and so let me talk a little bit before we get into that. I've got on the slide here the tax benefits, and you talked a little bit about them, but maybe talk a little bit more about the depreciation that somebody's able to use, effectively utilizing cost segregation in that plan, and the recapture or lack of recapture if you hold the property for 10 years.
Right. So if you remember when we were talking about this, you don't pay any capital gains or any gains taxes when you sell and exit the property so long as you hold it for 10 years. Well, what this means is you're actually encouraged to depreciate the building as fast as possible. So your time expires, for all intents and purposes, your time expires 25 years from now. The normal depreciation is a 27-year depreciation period. However, let's say you're one of those people that is going to get some payouts from the sale over time. You can actually, in certain buildings, certain kinds of developments, certain properties, you can do cost segregation and accelerate a good portion of the depreciation forward. Why is that important? A, you get more depreciation to offset your cash flow from the rent from the property. B, you get additional depreciation to offset additional cash flow that you might have, lowering your current tax bill. And C, when you sell it, you're not worried about it, how much you're going to make, because you don't pay taxes on the sale. So it's an opportunity for those of you that might not have a lot of depreciation left in real estate to create a lot of new depreciation, and quickly as well from an accelerated standpoint.
Awesome. Thanks for covering that part. We're going to kind of go back to some of these things and talk about what we really think is the great opportunity for people who want to get into opportunity zones, want to see the significant benefit of the tax incentives, put those to work for them, but they don't want to go build a property. That's not their thing. And they'd like to do it as, let's call it, minimally management intensive as possible. And so what we'll spend the rest of our time is walking through a couple examples and also talking about who's kind of the right people for this. And so I think it starts with, as Jason said, and we kind of covered it, who does this really work for, or the secret, who does it work for? It works for somebody who spent 30 or 40 years building a business. They acquired the building that their business operated in. Maybe they expanded and bought a couple more. But because of COVID or because of pricing, now is the right time to step aside. And they've had a significant liquidity event as it relates to the business. And with that, a big capital gain. And what do? Either pay the taxes, or can you defer some of the taxes for 5 years, but then also shelter all of the appreciation and gain from those investment dollars. So that's who I think is somebody who can really utilize an opportunity zone, looking to make things easier, looking to enjoy more time doing their passions, but also get some significant tax savings, but be in control of the property. On the real estate side, a lot of our clients have been reluctant to invest in, we'll call them public opportunity funds, where they're in a more passive seat and they can't control the outcome. And they can't make the decisions to do whatever they want to do with the property if that would be required. This way, through setting up your own opportunity fund and being in control of your dollars, you have a lot more control of the situation. So that works. It's also will work really well for general partnerships and limited partnership investors who want to go their separate ways. Not everybody has the desire or the time to do drop-in swaps or some of the other more complicated divestings of partnerships that would allow people to go their separate ways through a 1031 exchange. This way, a partnership can sell if they get an offer for the right price, and investors that have the capital gain will be able to defer it, and then their proceeds going forward or their profits going forward won't be taxed. So we think that's another one. And as Jason kind of mentioned, whether it's the NFT or crypto investors or somebody who bought Apple 30 years ago and has a significant liquidity event on one of those things, can redeploy this into maybe a less risky, more capital preservation sort of asset for some of the dollars that they've made profit on. So we want to start with that on kind of who this really works for. And I think Jason added a really good one. If you are of the belief at all that the 1031 exchange might go away, or that there's a significant percentage of the population that would like to see high net worth individuals taxed more on their gains or on their real estate gains, then utilizing opportunity zones, which was bipartisanly supported, is a great way to deal with your gain now, but shelter more of your future gain or all of your future gain as compared to just continuing to do exchanges and redeploy. Any other comments, Jason, on that, on who we think is kind of perfect for this opportunity and opportunity zones?
No, I think that fits them all. I mean, one of the things we'll talk about too, I think, Justin, that's interesting is how you look at this as, like, depending on what you buy, can be a base of your portfolio. When you're talking about credit from someone like Carroll's LLC or Chipotle or Starbucks or, big publicly traded operators, and if you're getting a 4.5% return on your equity, but it's offset by depreciation, so you're paying no tax, it's better than the bond portion of your equities portfolio. And so maybe you reposition different parts of your portfolio, to get more into real estate. And the difference is again, with even if they eliminate step up in basis, this benefit passes on to your estate. So that's something I've really started to think a lot about, is the benefit of as well passing it on to your estate and where it goes from there.
We got to make one little correction here, but looking at this slide, make that correlation again. You talked about, a diversified stock portfolio. Talk about the return on, let's say, bonds versus what should be 25%, the long-term net lease, how those returns look different today.
Well, so if you're looking at the bond market, I mean, even the riskier bonds from municipalities are 3.5% tax free. Maybe you push to 4 if you're getting really aggressive. But then again, we've seen cities go bankrupt. Here, you can get a double net lease deal potentially at a 4 and change cap rate, call it 4.25, 4.5, even. I mean, we're doing a deal at 5.5 with a big credit tenant guaranteeing the lease. And at that point, you have to feel really secure about the credit of the tenant. And it's probably as good or better than the credit of whoever you're buying the bond from. And it's a really great opportunity to consider it from that perspective, is how do I reposition my portfolio to get there?
Awesome. Thank you. I'm going to move on to, when we talk about and I'm trying to pull something up. Give me just a second here. When we talk about areas, and Jason mentioned it a moment ago, that there's 800 or some odd of these things across the country. We showed the map where there's plenty in California. This one we're going to show you right here. Walk you through this offering memorandum real quick, because we want to show you a map. And when we talk about, there's that intersection where it's like the perfect location in an opportunity zone for something like this. And this is an opportunity zone in Indiana. And I'll show you the map and why we like it. I mean, real quick, a couple other reasons why Jason and I have liked it so much. It's 20-year lease with a tenant that has 900 locations and is publicly traded. So the quality and the security is fantastic. But when we show you the map here, why we liked it. So it sits in an opportunity zone at the intersection of the main entrance to a university. And because of the way that opportunity zones work, when they look at incomes and population, there's quite a few that are in spots like this where they're near a college, or a college is in it, because the student population, there's so many of them, and they're not making much money, that they affected the way that the census tracts were determined in incomes. So in this example of a building in an opportunity zone, you're getting a great quality tenant, and this location is if you were to have a fast food burger place, I'd always take one steps away from a university. Jason, any comments on this location or any others that you've looked at recently?
No, this one's great, Justin. And I think actually, if you look at the map where the blue lines intersect, right where the orange dot is, where we're going, where our client's buying the property, I think that is like the edge corner of the opportunity zone too, right? It's just on the edge, across the street from the university. We just closed on an opportunity zone project for our client in San Pedro, on the water, to build 122 apartment units. And so there are some really great locations. There's a handful in Century City, Mid Wilshire. There are really some great opportunities all over the country. I mean, we have one also, Justin, that we're looking at in Roanoke, where the average household income within a 2-mile radius is $115,000, which is really high. So it's about finding the placement and finding those good opportunities. But to your team's credit, Justin, when we found this first one, we thought it was a little bit of a unicorn, and then all of a sudden we found 6 more that we really liked, and we're like, man, there's opportunities if you know where to go look. So.
Yeah, we've had good. I think our team has done a good job of researching and finding the ones, like you said, that are kind of like on the edge, where there's a lot of good happening in the opportunity zone and a lot of investment, and then there's lots of good business, good demographics nearby as well. So I just wanted to show you that a little bit about like what are some of the sort of locations that you can get. See if I can go back here a second.
And while Justin's pulling that up, we'll talk about, for those that don't want to actually build the project themselves, right? How do you get the benefit of the opportunity fund and doing the improvements without actually having to do all the work? And so, Justin, if you don't mind, I'll transition into that, because I think that's kind of where we're going.
Yeah, let's talk about that.
So for those of you and many of our, sorry, go ahead.
I said, I think that's the most exciting part for you and I.
Well, so the interesting thing is, not everybody's a builder, not everybody's a developer, not everybody wants to go out and do 2 years of construction to make something happen, or find a Chipotle or Carol's as a tenant and build it. So what the IRS has allowed is, if you find a property in an opportunity zone that is new construction and you're able to close prior to the property receiving its certificate of occupancy, which the IRS defines as the original use of the new property, right? So close a few weeks before, you get credit for all the improvements done by the builder. So essentially, someone else went in, someone else bought the property, someone else improved the property, and you get all the benefits as if you had bought the property, you had improved the property, and it's your deal from the beginning. Where this also becomes really interesting is there's a lot of properties where people owned them prior to them being designated as opportunity zones in 2016 that over the next 12 to 18 months are going to be coming up on certificate of occupancy. Because they owned it before 2016, they can't get the benefit of being in the opportunity zone because it wasn't purchased by an opportunity fund. But what they can do is sell it to someone like you potentially that are looking for a deal like that. Just prior to certificate of occupancy, you close, and we've already got signed leases, signed guarantees at month, 3 weeks, 6 weeks till completion, and you start receiving your rent pretty much right away.
Yeah, I think the thing to remember with the opportunity zones, right, and Jason just said it, is they want you to go in and make a significant investment in the community to create jobs. And so if you owned there before, you don't get any benefit. If there's an existing building that is at its highest and best use, there's not a lot of benefit. But there is benefit if you do something with it. And as Jason just said, the big thing is the original use date. So your property's been operating as a dry cleaners or a liquor store or a duplex since 1966. That's its original use. But if somebody were to scrape that and then they go put up a new apartment building, self-storage facility, Burger King restaurant, its original use date has to occur. Well, for the work for an opportunity zone investment, the original use date has to occur after opportunity zones were created. And as Jason just said, and kind of want to re-explain it, is that the original use date is the date that the property is placed into service according to the IRS. And there is plenty of IRS rulings, commentary, definition about when a property is placed into service. And if you see here, the couple things that a property is considered placed into service or a state of readiness when you have approval of all required licenses and permits, passage of the control of the facility to the taxpayer, completion of critical tests, or commencement of daily or regular operation. So if you're going to go buy a property that is currently being constructed, number 1 and number 4 both would apply. Getting the placed in service date to be after you close escrow. And so the original use of the property occurs while the Opportunity Zone Fund owns the building.
That's Justin, that being able to do that is huge for people that just want to be passive investors, that don't want to worry about going and building their own project, and people that don't want to have to pay fees to a fund manager, to a fund operator, to a developer at all. So that's where it becomes really, really beneficial.
And I think that the next component of it is, all right, well, if I can do that, how much work am I going to have to do? I think to Jason's credit, he's done a really good job in some of these examples where he's worked with clients in creating a lease structure that works really well for both parties. It satisfies the tenant, and oftentimes the tenant's desire to have control of everything at the property, basically a desire to have a triple net lease, but also allows for the fund to have an appropriate amount of management that allows them to meet the requirements of the opportunity zone. Jason, before we get into examples, we have 2 questions kind of back to the numbers.
Sure.
First, Alexander, I know you explained this already, but could you please explain again why taxes are due in 2026, 2027?
So let's just say, Alexander, you're in California when you realize your gain. So California doesn't recognize the capital gains portion of the tax code. So it's ordinary income. So you will realize that, let's just say this year, if you had the capital event, and have to pay your taxes next year. However, the federal government is allowing you to defer the payment of the federal capital gains tax until your 2026 tax returns, which are to be filed and paid April 15th of 2027. So the federal government is giving you, as a benefit, a delay in payment of that bill. Now, something that might be useful is if we did some cost segregation, for example, you accelerate some of your depreciation. If you don't use all of it, you carry forward loss for a few years, and hopefully you can offset a good chunk of the actual bill that would be owed just through cost segregation itself and the carry forward of the depreciation. And I think, Justin, if you want to talk through this slide first, and then I can answer the next question.
Perfect. Yeah. What we've got on the screen is really, it kind of shows you the numbers of the question that Jason just answered. So in this example, if I had $100,000 gain and I had it in 2021, if I deferred it by placing it into an opportunity zone, the 23.8% capital gains tax, 20% federal, 3.8%. I forget the exact, people call it Obamacare, but it has a much more official name. That portion of the tax would be all deferred. If you did it before 2026, you'd get a 10% reduction on that tax. So in 2021, when you finally paid it, you'd only have to pay $21,000. Is the example of $100,000. Now, the next thing that we're going to show you on here on the numbers is looking at two different types of investments. If I had $1 million gain and bought a property, invested it in an investment outside of an opportunity zone, or if I had $1 million gain and invested it in an opportunity zone. I'll walk you through the first column, which is the opportunity zone. I get $1 million from my sale. I pay no taxes because I defer till 2026. Gives me $1 million to invest. In 2027, as Jason said, I'm now going to pay $214,000 in capital gains tax, which are my capital gains from the $1 million that I made in 2021. Factoring in this example, they use 10% appreciation. We use a much smaller number in some models later. I pay no capital gains tax on any of that gain, that appreciation. So after 10 years, my net value of my investment is now $2.3 million. If I took that same $1 million, didn't invest in an opportunity zone, paid the $238,000 in taxes, and invested the $762,000, I'd have $1,976,000 after 10% appreciation for 10 years. When I'd sell it, I'd pay capital gains tax again on my appreciation, and the net value of my investment would be $1,687,000. So when you look at it and you go, okay, I've got a capital gain of $1 million, put the money in an opportunity zone versus not, it is a 41% benefit to invest in an opportunity zone. So it's significant how the opportunity zone investment can benefit the investor or can be utilized to retain significantly more profit. Jason, you want to answer the next one?
Yeah. So the other thing I was going to say, though, honestly, Justin, to what your point was too, is that 2027 doesn't factor in the dollars you get to use are $2027 with the inflation, right? So there's the benefit of paying down the road, and then there's, in your model on the lower half, there's an assumption that the capital gains rate doesn't go up by the time you go to sell it the 10-year hold period, right? So if there's an increase there, or if you want to pass it on to family, they get the benefit as well. So to answer the next question, they can be deferred. You just have to sell by the end of 2047. So 25 years now is how long you can defer it for. And you can defer as much of the gain as you want. So if you make $10 million and you want to put all 10 million in, you can use all 10 million. So you can use as much of it as you want. And Justin, the other thing with the model too is the benefit of offsetting some of the additional tax that's due in 2027 with depreciation as well. So really you could be looking at a much lower number even than that, and your returns could increase even more.
Yeah, and we'll show you that kind of right now. We're going to use an example of a Starbucks as an opportunity. On the screen here, you have, excuse me, if you purchased a property, not the Starbucks, for $2 million years ago, and depreciated 1.4 million of it, basically all of the value of the improvements. Ultimately, you sell that $2 million investment for 4.2 million. And your capital gain amount that you would be taxed off of would be 3.4 million. We calculate the capital gains tax. When you put it all together, recaptured depreciation, federal capital gains tax rate, net investment income tax, that's what it was called, and some California state capital gains would be about $886,000 in taxes. So we take our 4,280,000, we subtract our 278 in cost of sale, and then we subtract the capital gain that your $4.2 million sale gives you $3 million to invest in a property. I'd like you to remember that number because I'm going to show you here. In the case of you have that $3,015,227,000 to invest versus if you invest in a new construction or under construction Starbucks for $4 million, the monthly cash flow slightly different. You make $10,678 on the after capital gains purchase. You make $14,166 on a opportunity zone purchase. We look at 10 years of cash flow. We added the appreciation, which the appreciation will be larger on the $4 million property. The total return, you see on the right-hand side, we have the deferred capital gain, which we're going to pay that $886 in 2026. And then we have the capital gain on the left-hand side for when you sell the property in the non-opportunity zone example. 10 years down the road, you'd have 4.9 million in total profit from the investment, including your original purchase dollars, if you do a non-opportunity zone. And if you did an opportunity zone property, you'd be at 6.2 million. Now, Jason talked about the benefits of additional depreciation and some leverage. We're going to show you if you got some leverage using the same amounts as down payment in non-opportunity zone and opportunity zone property. When we factor in those loan payments to our equation, the non-opportunity zone property proceeds you 5.1 million and the opportunity zone property 7 million, which is a 40% increase. So in almost every example, the benefit of the opportunity zone for somebody who's out of depreciation or who would effectively be out of depreciation in a real estate scenario is a 40% benefit for opportunity zone investment. So what we've kind of uncovered, or what we think the great opportunity is that for people who have enjoyed a significant capital gain, maybe you don't have time to set up the opportunity zone fund. Jason, maybe that's a question. Can you set up an opportunity zone fund in 5 real estate days?
Maybe. If we really had to push it, we might be able to get one done if somebody really needed it done. It usually takes a couple of weeks, but we might be able to get it done before the end of the year. It's honestly, Justin, the big issue right now is Friday's a holiday. The following Friday's a holiday. Secretary of State's office is open to get things filed and returned back. If there was a pressing need, we might be able to pull it off. But if not, for sure, we could get it done in January. And like I said, the 10% benefit is helpful, but it's not required. It's not the end all be all on that transaction. And the other thing to keep in mind too is, you had to have had to realize the capital gain in the last 6 months and then have us set it up quickly, get your money in.
Well, and to your point, probably the least beneficial of the tax benefits would be the 10%.
Right.
Like even in this slide that we're showing, it doesn't factor in the 10% and assumes somebody doing this in 2022 and paying the full deferred capital gains tax at the end of 2026.
Right.
So, you know, so could he do it if he needed to? It sounds like he could. But more importantly, it's really about taking advantage of the opportunity in 2022. And we think that there is a way for passive investors to defer that gain, but not only defer that gain, make a significant amount of money by utilizing opportunity zones and pre-construction or in construction assets to provide a stable cash flow, a long-term, easy to manage asset with a great corporate tenant, and as Jason mentioned, probably more secure at 5 times or 10 times the return of some of the bonds choices that are out there, and defer some of those gains. Jason, any closing comments on the opportunity that we think that people have available to them that they should be jumping on?
No, I think this is something that you and I have become so excited over in the last month and spent so much time on, that if you do have a gain, and remember, it can be a sale of a business, it could be a sale of real estate, or it could be sale of a stock from an equities portfolio. It really is a great time to sit down with, Justin, myself, an advisor, and talk through how, repositioning into an opportunity fund protects you from, first changes in the law and tax rates, but also gives you all these benefits on upside. I mean, Justin, those examples show exactly how much benefit that there is. And, that's even without, probably accelerating some of the depreciation in the model. If you do that, there's probably additional benefit and value at the end of the day. So I really think that these are opportunities that, people should look at, and it's a great time to take advantage of it now, especially because I think there's a lot of new construction product that's going to be available over the next, let's call it 6 months to 9 months, that we can buy pre-certificate of occupancy.
As we wrap it up, if anybody's got a last question, please make sure to ask it. Jason, it's been a pleasure to do these with you really over the last year and a half as we've responded to, let's call it, changes in the market or opportunities that we've uncovered and worked on together. And I think really this might be the biggest one that we've uncovered in that year and a half. Not only for our people looking for, as we said, mainly passive or marginally active management assets, but also for somebody who may own property in an opportunity zone, hasn't known quite what to do with it, how to structure that transaction and maximize the value of that property is something that we can also work with people. It's not just helping people acquire these that are in the midst of construction, but also working with investors who may have the land that they want to monetize in an opportunity zone, but don't have the desire to build it, don't have the desire to chase the avenue to actually make it happen and get a premium on the pricing of their property for the benefits that we've just described. It's certainly been our pleasure to do this as often as we do it. I think that Jason and I enjoy the opportunity to talk with all of you about the things that are out there in the investment real estate marketplace. Wish everybody a happy and healthy holiday, and looking forward to 2022 being as exciting and wonderful as the business opportunities were this year. Thank you.